Should we look for deals with giant returns? Now, that sounds very obvious. Of course, you want to get the biggest return that you can. But you know what? That is not always true in the syndication and the fund business. Not that you don't want to get the best deal that you can, not that you don't want to maximize the use of the capital. Of course you do. Those are always things that you want to do. But sometimes when you look for deals with giant returns, they have excessive risk. Sometimes they have projections that are just improper because there's a certain range that most opportunities fall into. And that range is somewhere between maybe 10 and 20% annually. And then you share that money with the investors, and maybe the investors are going to get somewhere in the 8 to 15 range. If you start promising investors that they're going to get 20, 25%, 30% more, now it happens sometimes, but if you start promising them those numbers, first of all, they're probably not going to believe you, and that makes it hard to raise your capital. Second of all, if you deliver those kind of returns and then the market softens, and this happened, for example, in Phoenix, some years ago, the market was absolutely cratered at the bottom. People that bought in, they were making 20, 30, 40% a year for some number of years in a row. And then it cooled off and it starts to stabilize. And then the syndicators would go back to the investors and they'd say, hey, listen, we're looking at 20% on this deal. And the investor would say, well, the last time we got 30, what happened to 30? Oh, well, the market's kind of cooled down, it's kind of stabilized. So now we're looking at deals that are 20. Some investors who get spoiled at 30 are going to say, well, you know what, there's another guy offering me 30. They don't know that it might be, pulling their leg, but they just kind of get used to this. Sometimes they get greedy and that's what happens. And they'll say, somebody's offered me quite a bit more than you are, so I think I'm just going to go with those guys. And you might have returned buckets of money to people who then go to a competitor because they make a promise that's better than the promise that you're willing to make. And that's the reality of how this business works. So you don't really want, sometimes, listen, if it happens and you find a fantastic return, that's fantastic. That's just great. But you don't always find deals that have fantastic returns. I mean, there could just be good, stable deals. People aren't buying the real estate syndications and the private placements and the fund structures so that they can get 30, 40% returns. You want to do that? Do commodities, do options, do venture capital. Real estate's a pretty stable asset that returns a pretty reliable amount of money most of the time. I mean, there's ups and downs and there's capital gains and losses, but most of the time it's pretty reliable. So when people get involved in this sort of thing, they're expecting something that's pretty predictable. And 20, 30, 40% is not predictable. It's not even believable. So I'd be very careful about making those promises because you really want to bring in the dollars to your deal. You want to make sure you close your deal. The most important thing is to get an investor to say yes when you ask them to come into your deal. And if you make promises that seem wild and crazy, you got to think about how they perceive that. It's not always going to be perceived positively, and they may not end up coming into your deal. So think about those things because this is a great business as long as you go out and stake your claim.